because we take all the information, we share the slides, we share the videos, and it's got a life of about a year, I think, as we can keep posting it out. Because whenever I hear of Canada, I say, oh, you must look at this webinar, and we push it out there. And obviously, there's a lot of time differences. So I understand that we do a lot of things like the gap we did recently, Kalin. I'm afraid that was 3 in the morning for you. But I put Phil onto your case, who's the one of the main guys at the gap, and he'll give you a personal view. Anyway, that's getting off topic. The main topic for today is why do business in Canada with Paul and Kalin from S+C Partners. I am Andrew from TGS, the network. I'm easy to find on LinkedIn if you want to speak to me. And I'll hand it over to S+C Partners just now. Thank you very much, guys.
Thank you, Andrew. Delighted to be here with you today. I'm going to spend a couple minutes introducing S+C Partners, give you the kind of boots on the ground view for who we are, and then turn things over to my very capable tax practice leader, Paul.Keul, who will take us through some of the tax considerations about doing business in Canada. And both Paul and I promise to keep the number of A's to the absolute minimum. Here on this slide, Paul, thank you, is our new flagship headquarters in Streetsville, Ontario. Streetsville is a town within the city of Mississauga. And for you geography buffs, Mississauga is a city of 800,000 people, and it's about 30 minutes from downtown Toronto. Downtown Toronto would be about 2.8 million people. And so between Mississauga and Toronto, we have quite a big population. And so we moved into our new premises here. It's about 10,000 feet on 3 levels a year ago, and have still yet to have a grand opening. So we look forward to doing that near term when we can open our business to the post-pandemic. How's that? Today at S+C Partners, we're 71 persons, and our purpose is to deliver the best possible service experience and outcomes for our clients. And you know, our purpose is based on several core values. Those include empathy, quality, integrity, teamwork, growth, and social responsibility. And part of that ties in with TGS and their global sustainability mandate. So we are a believer in that as well. Here on this slide, you see the beautiful faces of our tax team. We have 15 people working in the tax area out of our office here in Mississauga. And Paul joined us in 2008, so he's been a long timer with us. He joined us from Deloitte. Anik has been with us for more than 20 years. 2 team members, Simon and Satapon, our Director of Canadian Tax, they joined us from KPMG's Waterloo office, which is just a little west of Toronto, 2 years ago. And Priya also joined us in 2013. So you're looking at the best and the brightest in terms of the tax practice area here at S+C Partners. There's an old photo. I think, you know, Horacio, certainly Andrew, you're in that photo, but we've been a proud member of the TGS network since 2015. And we did host the annual conference in November 2017. And that was held downtown at the Royal York Hotel across the street from Union Station. And we did have the opportunity to take the team up the CN Tower. And I don't know what it is with TGS and towers, but we do seem to visit them, whether it's the Burj Khalifa in help me, Dubai, or the Petronas Towers that we've also visited. But we have our very own CN Tower, which now sadly seems to have fallen to the bottom of the list in terms of world's tallest structures, because we keep building taller ones. But another highlight from that conference is we had Toronto Football Club's coach, Greg Vanney, who won the MLS Cup, which is Major League Soccer, which is our, what I'll call a North American Premier League. And Greg came and spoke to us at that conference. So we were delighted to, you know, host that conference and hope to one day do that again. And, you know, a shout out to our friends, Jeroen at Lime Tree and Brian Schwam and Guy Saint-Chagrin at WTP Advisors, who we work very closely on the ground here with in Canada. I should point out that, you know, working here in Toronto, we are driving distance about, you know, 1.5 to 2 hours from land borders with the United States. So our close proximity to the United States by land borders is why we often think about our friends to the south and doing business in North America, and why, you know, Canada is a gateway to working in North America. And I think these, propositions on the screen are somewhat self-evident, that the rule of law is paramount around here, that there are investor protections, and we have low corruption. In terms of, large, economic considerations, we have the 9th largest economy in the world by GDP. We have a strong natural resource sector. It's estimated that we have, we rank 3rd in the world in terms of, the value of natural resources. 3rd largest proven oil reserves, and 4th largest exporter of petroleum products. And I think maybe one thing that our attendees today may not know is that we're also a global leader in the entertainment software industry. Of course, Canada is a member of APEC, the G7, the G20, OECD, and the World Trade Association. Moving on to our workforce, you can expect that here in Canada, we have a highly educated workforce, many of them post-secondary trained, and some of the world's top universities. And I can speak firsthand to that. My eldest daughter is in 3rd year at Western University, which is in London, about 2.5 hours west of Toronto. And my second daughter, Ava, she's at McGill University in Montreal. So I'm paying tuitions to 2 very fine universities right now as we speak. I mentioned briefly about the gateway to North America. So again, the US, similar social norms. Back in 2020, we opened up our free trade agreement with Mexico and the US, and we concluded the USMCA. So we now have a new free trade agreement with both the US and Mexico, which it seems the US is about to violate by providing some significant incentives in the electric car business. And so we'll see how that all plays out. But, domestic automobile manufacturing is a big part of our Canadian economy too. And of course, we do have a tax treaty with the US. And I know Paul will talk about some of the other tax treaties that we have with other countries around the world a little bit later. You can picture Canada bounded by kind of 3 oceans, to the north, to the west, and to the east, with 3 large cities, many of which you'll know: Toronto, which we're immediately west of, Montreal, where my daughter Ava is, and of course Vancouver out to our west, with several ports and airports. And the Toronto Stock Exchange, now that's called the TSX, is the 8th largest stock exchange in the world. And we have another senior exchange called the NEO, and a venture exchange for startup companies too. So access to capital markets is also important. I talked a little bit about the auto manufacturing, and we do have a technology sector with a strong presence west of us in Waterloo. That was where the Research in Motion and the BlackBerry was kind of invented, and they continue to exist in a different form today. Let's talk about the Canadian dream. There's a number of ways that you can rank a country in terms of the world, but we were rated #1 in April 2021 by the US News and World Report. And why were we ranked #1? I think it's freedom, quality of life, a great place to live and raise a family. Women are viewed as effective leaders in Canada, and I think that's a big part of our social fabric here in Canada, and obviously the advantage of a taxpayer-funded healthcare allows people to raise families without concern of expensive medical treatments potentially. So, and if we talk about multicultural, Toronto is the best city in the world, bar none, to find something to eat. We have so many different ethnicities and cultures that we have the greatest food in the world. So that's a little background about S+C Partners in Toronto. And now I'm going to turn things over to Paul. He can take us through some of the tax and other business considerations for doing business in Canada.
Thanks, Kalin. Yeah, there's an old expression that tax practitioners use, at least people that I learned from and mentored me, and that is that the tax tail should not wag the dog, but when making business decisions, it is of course important to be aware of the tax issues and tax implications. And so I'm going to walk through some of some of those tax issues that affect businesses operating in Canada, and particularly from the perspective of international business coming into Canada and starting to operate and expand into the North American market. The Canada Revenue Agency is the government agency, the government body that administers the Canadian tax system, and we refer to them as the CRA. Most businesses in Canada operate as corporations, and the corporate structure provides a number of benefits. One benefit is that corporate income tax rates are lower than personal income tax rates. So that creates opportunities for business to reinvest and grow. When operating a corporation in Canada, it's important to know that the tax owing for the year needs to be paid not only throughout the year in installments, but any balance owing at the end of the year is due 2 months after the end of the fiscal year. And then the tax return itself needs to be filed within 6 months. In Canada, we have embraced IFRS, and S+C Partners is very familiar with IFRS and can prepare financial statements and issue audit reports, et cetera, based on the international financial reporting standards. Private companies in Canada also have the option of using a separate set of accounting standards, which we refer to as ASPE, which is a little less onerous than the IFRS disclosure standards and appropriate for that different market of family-owned business or private companies. Residency is an important concept in Canadian tax. The Canadian legal system is largely based on the British common law system. And so there are a number of things that come up in Canadian law and therefore in Canadian tax that are not defined in legislation. So the question of who is a resident or what is a resident of Canada when we're talking about a business entity starts with the common law principle of where central management and control is exercised. But then there are also some provisions within the Income Tax Act that may override those principles. The reason why residency is so important is that Canadian resident, whether Canadian resident individual or a Canadian resident business corporation, for example, that Canadian resident is subject to Canadian tax on worldwide income. If a business, a corporation is considered Canadian resident, then all of its profits, wherever earned in the world, are going to be subject to Canadian tax. On the other hand, a non-resident of Canada is only subject to Canadian tax on Canadian source income. And then there are two ways that income is taxed. We refer to Part 1 of the Income Tax Act. That is the bulk of the tax legislation, and it deals with things like employment income, business profits for a business carried on in Canada, and gains from the sale of certain assets. Part 13 of that same Income Tax Act is the portion of the Income Tax Act that deals with passive income or other sources of income earned by non-residents, but which are taxable in Canada. This simple phrase, carrying on business in Canada, actually can be quite difficult to define. It is not defined in legislation, but it is very important if there is a business and that business is being actively carried on and it is being carried on in Canada, then it is taxable in Canada. But each of those points must be examined to confirm whether the activity is taxable in Canada, particularly if we're talking about a non-resident carrying on the activity. Certain things like manufacturing are defined to be carrying on business. So if a business enterprise has a manufacturing facility in Canada, that will be considered a business carried on in Canada, and the manufacturing profits will be taxable. On the other hand, a non-resident business that is purchasing goods in Canada and exporting them, or selling goods or services to Canadian customers, may not be carrying on business in Canada. And so those types of activities could be undertaken without attracting Canadian tax. Functional currency, very important. The default is that Canadian taxes are computed based on Canadian dollars. So if a foreign business is carrying on activities in Canada that constitute a business being carried on in Canada, those profits need to be computed in Canadian dollars, and that can give rise to foreign exchange differences. You do have the option to calculate your Canadian taxable income under a different currency if your business functions in some other currency, whether that's the US dollar, the euro, the pound. Making that election does generate some complexity, but that is an option that is available, and we can help with that if it's appropriate. As I said earlier, the main income tax that applies in Canada is under Part 1 of the Income Tax Act. More importantly, it is a tax on net income. And for corporations, that ranges from a low of 9% to a high of 31%, depending on a number of factors. It's important to understand the geography of Canada. We are a federal country. There's a national government that we refer to as the federal government. That federal government levies a tax that is the same across the country. But then there are 13 provinces and territories, subnational governments, which each have their own tax rate that applies, their own set of rules that may apply to businesses operating in that specific geography. And so there's a range of tax rates that may apply. For any foreign-owned business, global business expanding into Canada, the rates are could be as low as 17.5% for manufacturing and processing profits, up to 31% for regular other business that doesn't qualify for that manufacturing deduction. A CCPC is a Canadian-controlled private corporation. Those lower rates are available to businesses that are primarily owned by Canadian residents. Just a brief point of comparison, because we are so close to the US, we often compare ourselves to the US, and in terms of tax rates, the US federal tax rate is 21%. State rates vary greatly, but average probably around 5 or 6%. And so the total corporate tax applicable to a business in the US is similar in scope to the rates that you would face in Canada. One significant difference is that in Canada, there is no consolidated filing of tax returns. Each entity needs to file its own separate income tax return. So if you have a group of companies, one that may be in a profitable position, one that may be generating losses, the losses cannot be offset against the profits of those individual related companies. And that can create inefficiencies from a business perspective. And so managing that situation is often an important consideration in planning in Canada from a tax perspective. The other type of tax that non-residents investing in Canada need to be aware of is the passive withholding tax, or withholding tax on passive income. And this applies to everything else, everything that was not covered previously under the active activities, business income, or employment. So in particular, withholding taxes apply to such things as dividends and interest, royalties and rents. The default tax rate for this type of passive income is 25%, but that is generally reduced based on tax treaties that Canada has with various countries. This is a tax, though, on gross income, and there are no deductions in computing the income subject to tax. The one exception to that is rents. So if you have a non-resident investor that owns Canadian real estate and is earning rental income from that real estate, there are options rather than paying 25% tax on gross rent, which would make the ownership of real estate generally uneconomic. The Canadian tax system recognizes the unique nature of real estate investing and provides this option where the non-resident investor can elect to file a tax return and calculate the net rental profit and pay tax at ordinary rates, ordinary income tax rates on that net profit. And there are also options to improve the cash flow by electing in advance to and promising to file that annual tax return. The withholding can be reduced from 25% of gross rent to 25% of net cash. By making that election in advance, you're also committing to meet the 6-month deadline for filing your tax return. And there is no leniency on that. We have seen situations where non-residents have made the election in order to improve cash flow, reduce the withholding requirement, and then failed to provide the necessary information on a timely basis to file their tax return. If you miss that 6-month deadline for filing the tax return, there's a retroactive responsibility for 25% of gross rent, interest on that, penalties, and no option for reducing the tax. The other withholding tax that catches people off guard is this Regulation 105 withholding that, and that's how we tend to refer to it as Reg 105. This is not a final tax. This is completely different from the tax on passive income. This is an encouragement to file a tax return tax. So if a non-resident is providing services to Canadian customers and sending, for example, an employee from overseas to Canada to render those services, the Canadian customer is required to withhold 15% from the fees paid for those services and remit that 15% to the CRA. That, as I said, is not the actual tax cost to the non-resident business. It's merely an encouragement for the non-resident to file a tax return and to establish whether or not they are carrying on business in Canada, whether or not a treaty applies that might exempt those profits from tax, and then to claim a refund if the 15% withheld was more than the actual tax owing. This is a requirement that many Canadians don't know about, and Canadian customers can get into trouble for not meeting that obligation to withhold. Often this comes up, a couple of years after the fact, when CRA may be auditing the Canadian customer and looking at their expenses and say, hey, what was this consulting fee that you paid? Who did you pay that to? And that's often the first indication for the Canadian payer that they had such an obligation. The other withholding requirement is on payroll. Obviously, Canadian business that has Canadian employees would be subject to payroll withholding requirements. That's probably not a surprise to anyone. But the other side of that to keep in mind is back to our scenario where a non-resident business is sending an employee to Canada to provide some services to a Canadian customer. That employee who is coming to Canada to provide some services is now working in Canada. And depending on the length of time that they are spending in Canada and what they're doing here and what treaties may exist between the home country and Canada, the non-resident employer may now be subject to requirements to withhold payroll taxes, withhold personal income tax from the paycheck of that employee, pay into Canadian Social Security programs for that employee. One important note here, although Canada does have this withholding of income tax from employment income, it's very different from the pay-as-you-earn system that I have seen in other countries, particularly in Europe or I believe Australia. The tax withheld from an employee's paycheck is not the final tax owing under any circumstances. Every employee is required to file an annual income tax return, calculate their actual tax liability, and the tax that was withheld from their employment income is merely a prepayment towards their final tax liability. And then they either have a refund that they're entitled to, or they need to make a payment if the actual tax calculation is different from what was withheld. It's very unusual for the tax withheld from your paycheck to equal your actual tax liability. There's almost always a refund or some balance owing. Taxable Canadian property is the term defined in the income tax legislation for assets that are subject to Canadian tax if they are sold by a non-resident. Primarily, taxable Canadian property is real estate. Real estate located in Canada is going to be subject to Canadian income tax when it is sold. The other primary asset that falls into this category is business assets. So if we have a non-resident business carrying on business in Canada through a branch, for example, those branch assets, including intangibles, customer lists, goodwill, all of that value related to that Canadian branch is going to be caught within this definition of taxable Canadian property and subject to Canadian tax if sold. In order to ensure that non-residents pay their tax on the sale of taxable Canadian property, the purchaser of that property is required to withhold. Again, 25% default Canadian withholding rate applies to the sale of taxable Canadian property by a non-resident. Once again, similar to the real estate rental scenario, sale of Canadian real estate or other taxable Canadian property, there's an option to reduce that withholding if you notify the CRA in advance of the sale. So once you have an agreement of purchase and sale, you want to file some paperwork with the CRA to establish the amount of gain that would be recognized on that sale. And you can generally get the withholding tax reduced to 25% of the gain as opposed to 25% of the proceeds. And that can speed up the cash flow. Still requires the filing of an income tax return, report the gain, calculate the actual tax on the gain. Generally, then there's a refund. If you've filed the 116 certificate in advance, then generally you're looking at a small refund when filing the tax return, as opposed to having had 25% of proceeds remitted in advance. Branch tax is really just a replacement for dividend withholding tax. If a global business expands into Canada and sets up a Canadian subsidiary earns profits, pays income tax on those profits, and then repatriates those profits to the foreign parent company, that payment out of Canada in the form of a dividend will be subject to withholding tax at 25% if there's no treaty. Most of Canada's treaties reduce that to a 5% tax. But if the foreign parent company, foreign business, were operating in Canada without setting up a separate Canadian subsidiary, simply operating through a branch, or I know some jurisdictions would refer to it as a representative office, that is not a separate legal entity, and as a result, repatriating profits does not constitute the payment of a dividend. Canada is not willing to give up its tax on the distribution of those profits, and so it has implemented a parallel tax on the branch at the same rate as the dividend withholding tax. Again, if there is a treaty between Canada and the home country of the parent business, those treaties reduce the branch tax from 25% to the equivalent tax rate that would apply to dividends. Some of Canada's treaties, the US as an example, the UK treaty I know has the same provision. Canada will exempt the first $500,000 of branch profits from the branch tax. And that's a concession that Canada has made to encourage foreign investment and to enable foreign companies to test the waters, set up an operation in Canada, perhaps set up through a branch rather than incurring the costs of setting up a separate legal entity here, and can earn up to $500,000 of profit, repatriate that to the home country without suffering this extra 5 to 25% tax. Part of the recent initiatives globally has been the BEPS, Base Erosion and Profit Shifting program. Canada has had something in that regard for many years before the OECD started really focusing on that in recent years. We refer to those as thin capitalization rules. And essentially, these rules ensure that when a multinational is setting up Canadian operation, that the capital that's used to fund that Canadian operation are appropriately balanced. If debt is loaned, if money is loaned to the Canadian operation at interest, those interest payments are tax deductible, reduce the Canadian tax base, and often subject to 0 to 10% withholding tax, depending on the treaty between Canada and the parent company. Whereas equity that is invested in the Canadian business generates profits that are taxable, and then dividends are also subject to withholding tax. And so Canada requires that the debt to equity ratio be not more than 1.5 to 1 with respect to foreign related party debt. If that 1.5 to 1 debt to equity ratio is exceeded, the excess interest is not only non-deductible, but it is treated as though it were a dividend and subject to withholding tax. Canada, one of the advantages of investing in Canada from overseas, particularly as we look at Canada, as Kalin had mentioned, as a gateway to the North American market, one advantage we have is a significant network of tax treaties. Canada has 96 tax treaties in force, will soon be over 100 bilateral and multilateral tax treaties, as well as 24 tax information exchange agreements with various international financial centers. With apologies to our US friends on the call, it's easier and possibly less expensive from a tax perspective to enter the North American market through Canada rather than entering through the US. And I would simply point out that if you invest, skip the slide. If you invest into the US and then have your US subsidiary set up a subsidiary in Canada, the Canadian profits are going to be treated as offshore income earned by a controlled foreign corporation of the US parent, which gives rise to significant disclosure requirements and possibly US tax on Canadian profits. Although given current tax rates, there shouldn't be an additional US tax cost on that. But the paperwork is onerous, and conversely, a Canadian entity which has a US subsidiary has much less onerous disclosure requirements to Canada as compared to the US CFC controlled foreign corporation reporting. Just touch briefly on personal tax issues. This could be important if you're setting up a Canadian operation and sending executives, key employees, transferring from overseas to Canada to manage the new Canadian operation. In Canada, not only do we not have consolidated filing for corporations and corporate groups, but we do not have consolidated or joint filing for families or couples. And this leads to potential disparities in the tax cost for a family. As you can see on the chart, tax rates are comparable to Europe, I would say. Top marginal rate on individual income at 53.5%. That's the combined federal and Ontario tax. It does vary slightly depending on which province you're living in. But I think a significant difference between the Canadian tax rates and tax rates seen elsewhere is that the 53% tax rate applies to individual income in excess of $220,000 per year. And so if you, for example, had a family with a family income of $250,000, you would have a very different total tax cost if each spouse was earning $125,000, or if one spouse was earning $250,000 and the other spouse had no income. And that's something that needs to be kept in mind if you're setting up a tax equalization policy, or simply helping an employee to evaluate the implications of a potential move. And it also becomes a key point for a lot of the planning that we do for high net worth individuals, is looking at what can we do to manage income across the family and ensure that we don't have a situation where one spouse or one family member has no income and other family members have high income and suffer those higher marginal rates. That brings us to the end of the presentation, and we'll be happy to take any questions that you may have.
Thanks, Paul. Thanks, Kalin. That's excellent. I must say, when I was having a little look on free trade agreements for Canada, I was super surprised at the amount that there were. I thought, I'll make a little list, and there's like there's like loads of them. Just looking at the Canadian government website, and think, all right, okay, that's
yeah. Tax treaties, and you're right, free trade agreements. We have a lot of trade agreements, North America, Europe, Asia.
Excellent. So I don't know if anyone in the audience wants to unmute. If you mute a question, if you have any questions.
I'd just like to comment that another advantage of being in Canada, the US, and Mexico is that well, you have access to the big market due to free trade agreements, right?
Right. Good point, Horacio. Yes. That USMCA, or depending on which country you're in, put your own initials first.
Yeah.
But that is a huge advantage for investing in any of our three countries, the ability to access that entire North American market.
So, Paul, what you recommended about entering the U.S. market through Canada, would it be so? If I wanted to, I don't know, sell whatever trinket in the U.S., are you suggesting that it's better to set up a business in Canada, manufacture in Canada, and then import it to the U.S. via Canada? Would that be the recommendation? Did I get it right?
It can, yes, that can be very attractive, and I think our point really was, we have seen situations where companies entering the North American market start with a U.S. entity because the U.S. is the biggest market across North America. And then from the U.S., they decide to expand into the Canadian market and set up a Canadian subsidiary of their U.S. entity, and the U.S. becomes the North American parent. And that can be expensive, potentially from a tax perspective, but more so from a compliance perspective, because the U.S. compliance burden is really significant as you start setting up foreign entities owned by a U.S. company. But to answer your direct question, yes, if you're looking at manufacturing and selling into the U.S., doing that through a Canadian entity can be very attractive.
And obviously, if they're not a U.S. holding and Canadian subsidiary, there wouldn't be those reporting issues.
That's right.
If it's an owner of a U.S. company and the owner individual of the Canadian entity, there wouldn't be those reporting burdens, right?
That's right.
Okay. Well, yeah. I'm gonna be sharing this presentation with my clients so that they consider it as an option.
Thank you.
Thanks, Horacio. I have a question just before anyone else jumps in with a question, but as we do these webinars, I wonder, can S+C Partners kind of hold my hand if I come to Canada, from opening a bank account to setting up my business to doing my returns? Is that a kind of, can you offer a complete service there?
Yes, there are some things that we can't do. For example, incorporating an entity in Canada is a legal process, and as accountants, we're not allowed to practice law in Canada. But we have very good relationships with a number of local law firms that we refer clients to for that. We have very good relationships. I have worked through the process with RBC, which is one of the largest banks in Canada. One of the largest banks in the world, really. And I've worked through that process with a manager here in Mississauga. How do you open a bank account for a foreign entity when the directors can't walk into the branch and present their identification? That know your client and anti-money laundering regulation that has evolved has made it challenging for non-residents or people outside any country to open a bank account. But I've got a personal relationship with a couple of bank managers here who know how to do it and can streamline that.
That's fantastic. Thank you. Yeah, because it's just listening to your presentation, it's really clear. I think that often when we have clients who think about it, they think they can save money by doing things on their own. And it sounds like it's a real false economy, because like you just don't know all these small details, and they end up being very big details.
I had a quick question on how the personal tax rates work. I got a little sticker shock when I saw over half income is is tax. But how does it work with a couple, like a working couple that, let's say, you mentioned if each spouse earns 125,000, so are they in the lower brackets then, each one, or like in the U.S. we would combine them,
right?
So so how does it work in Canada?
In Canada, each of them would be in the lower brackets. If each of them has $125,000 of income, neither one of them has got to that, they're really into that, mid 40s marginal bracket, as opposed to, on combined basis, if it was just one, the one with 250,000 of income would have pushed right through all of the brackets to the 53.
Got it. So a small business then, where it's a family-owned business, there's some significant tax planning there that can be done in terms of balancing off salaries.
That's right.
Such.
That's right. And it becomes important to, determine what's a reasonable salary for that other family member.
Right.
And that becomes often a source of dispute with the CRA. Is that family member actually doing enough work to justify that wage?
Like a child, right? An 12-year-old child. Yeah. We have that issue too. Thanks.
That's fantastic. Thank you very, very much, Paul, Kalin, Bianca. Thank you very much for creating this presentation. It was really excellent.
Andrew, a quick question. Can I do it just fast? I don't know if this is for this forum, but can you tell us generally, or in very general terms, what does it take to become a Canadian resident?
It's very easy from a tax perspective to become a Canadian resident, and that's the conversation I have quite regularly with clients, is the distinction between your immigration status and your tax status. I've had clients say, well, my permanent residence application is going to take 3 years, and so I guess I'm not resident. But from a tax perspective, if you come to Canada with the intent of staying, you're resident from the day you arrive. If you travel to Canada frequently and over the course of a calendar year spend more than 183 days, so more than 6 months in aggregate in Canada, you will be treated as being resident for that year. And so, frequent business travelers can trip over that and find themselves subject to Canadian tax reporting. Again, if they're also resident in a country, one of the many countries that we have a treaty with, the treaties will have provisions to deal with that dual residency, but it still creates paperwork and filing obligations.
Okay, thank you, Paul.
Okay, excellent. Thank you so much. So again, Horacio will share the recording as soon as possible, probably later on this morning.
Please, thank you.
Kalin, Paul, Guy, Horacio, thank you very much. Bianca, thank you very much for being with us. There's quite a few people listening in. A couple of names I recognize. Igor, great to see you. Justine, great to see you there as well. And if you want to reach out to Paul, Kalin, or anyone here, I'm sure you can connect on LinkedIn, and you'll find their contact details at the end slide of their presentation also. Thank you very, very much. Enjoy the rest of the day for you, the rest of your long day. For us over here, it's almost finished, although I'm still in Canada for our next meeting with Susan Hart. So that's great. Thank you very much, everybody. See you the next time.
Take care. Bye-bye.